Lululemon might be the most undervalued stock in the stock market right now. The most recent shareholder letter from the CEO has seen massive growth opportunity year over year in markets like China internationally, as well as the domestic U.S. market. Most recently, their annual revenue also increased to over $10 billion for the first time ever in the company's history. Now, this company has a long history of growing revenue at double-digit rates and took a hard stumble with the stock down almost 50%. Let's take a deep dive into Lululemon stock, figure out what we think it's worth today based on how much cash money it's going to generate. And special guest Grok is going to join us for an AI commentary along the way. You ready to do this, Grok?
Let's talk about Lululemon stock. Recent data shows their revenue hit $10.75 billion for fiscal year 2025, with international markets, especially China, growing at 39% year over year. The U.S. market, though, is sluggish, with only 2% growth. That 50% stock drop you mentioned could signal undervaluation, especially with their strong cash flow and no debt. Want to dig into what's driving the valuation or their growth potential?
Let's talk about their stores. Tell me how many stores they have and how a store has been growing over the past several years.
As of February this year, Lululemon operated 767 stores in 23 territories worldwide, with most being in the United States. Back in 2012, they had 211 stores globally. By 2019, they'd grown to 491, and in 2022, they hit 655. That's a steady climb, with about 50 to 80 net new stores added annually in recent years. For 2025, they plan to open around 100 new U.S. locations, aiming for over 800 stores stateside. Their strategy focuses on urban and suburban areas with high retail potential, plus new markets like Italy and franchises in places like Denmark and Belgium. Want me to break down the U.S. store distribution or their international growth?
I want to read a comment from the shareholder letter from the CEO. It says, in 2024, we surpassed $10 billion of annual revenue for the first time, driven by growth across our merchant categories, channels, and markets. Adjusted earnings per share increased 15% year over year, and we ended 2024 with $2 billion in cash and cash equivalents and no debt. That's a very strong comment by the CEO. What do you think?
That's a solid statement. Surpassing $10 billion in annual revenue for the first time is a huge milestone for Lululemon, showing their ability to scale across different product categories, sales channels, and global markets. The 15% increase in adjusted earnings per share signals strong profitability, and having $2 billion in cash with zero debt is a fantastic position, lots of flexibility for growth or handling market dips. It sounds like the CEO is confident in their diversified strategy, especially leaning into international markets to offset slower U.S. growth. Want me to pull more specifics from that letter or analyze what this means for their stock valuation?
No, he continues by saying this performance is a testament to our established strategic plan and builds on our momentum over the past 5 years, during which we have more than doubled our total revenue and expand our fleet of company-owned stores by nearly 50%. Why is the stock down so hard if revenues have more than doubled?
That's a great question. Even though Lululemon's revenue has more than doubled and their store count has grown by nearly 50% over the past 5 years, the stock is down about 50% from its peak of around $423 last year, as you can see in the finance card above. The drop seems tied to a few factors. U.S. market growth has slowed to just 2% recently, showing consumer caution, which spooked investors. Plus, competition in athleisure is heating up, and there's broader market uncertainty impacting retail stocks. Despite strong fundamentals, like that $2 billion cash reserve and no debt, Wall Street might be pricing in fears of a tougher road ahead. Want to explore how their cash flow or valuation metrics could counter this drop for your video?
Actually, let's dive in. I'm going to do a screen share, and we're going to run through their financials. I want to take a look at their income statement, balance sheet, and cash flow like I always do. So let me dive into our cash flow club. We're going to pull up the most recent financial statement and take a look. All right. Here we go. Let's here we go. Let's dive into the cash flow club. Grok, I got you up on the screen so we can see what you're typing. And then we're sharing the 2025 full year P&L full year ending February 2, 2025. So for those of you that aren't familiar with fiscal years, it's basically the prior 12 months. So it's February 2nd and back 12 months, which is the majority of 2024. So you can think of this as the 2024 calendar year, for February forward earnings. All right, here we go. Let's take a look at top line revenue. So it says net revenues. By the way, a comment, it always says net revenues on the P&L because that could be net of like discounts on products that are given to customers, net of returned products or refunds. There's some things that would reduce revenue. So that's why the headline here is always net revenues as opposed to total revenue. $10,588 million in 2024. That is a new all-time high for them. 9.6 the prior year, 8.1 prior to that $1 billion. Grok, what's the annual growth rate there between those 3 years?
The annual growth rate from 2023 to 2024 is 10.07%, and from 2022 to 2023, it's 29.63%. Over the 3 years from 2022 to 2024, Lululemon's revenue grew at a compound annual growth rate of about 30.55%. Want me to break down the math or dive into something else on the P&L?
No, you're good. Just be with me for math when I ask for it. So that's a double-digit growth rate on revenue, and then they grew revenue from $10.5 billion last year, from $9.6 billion in 2023 to 10.8 billion, 10.6 billion in 2024. That's $1 billion increase in top-line revenue for a business that you, Grok, described the U.S. market as sluggish. Sluggish growth is still growth, by the way. So let's be clear. The stock is still growing. Let's talk COGS margin for a second here. So gross profit is the main driver of profitability in retail companies. So you want to see a high gross margin and a gross margin that is being maintained. Grok, can you pull or come up with the gross profit margin for Lululemon over the last decade, and what has it done in the most recent years compared to the 10-year average?
For Lululemon, the gross profit margin over the last decade has generally trended upward, showing improved efficiency in managing production costs. From 2016 to 2025, it ranged from a low of 48.39% in 2016 to a high of 59.22% in 2025. The 10-year average from 2016 to 2025 is roughly 54.65%. In recent years, the margin has been stronger, 55.39% in 2023, 58.31% in 2024, and 59.22% in 2025, all well above the decade average. This shows Lululemon's been boosting profitability, likely through better pricing or cost control, even with slower U.S. growth. Want me to calculate anything specific from this for your video?
No, we're filming live, so you're doing it as we go. You said 59% in 2025?
Yep, 59.22% in 2025, their highest yet.
So they keep almost 60 cents on every dollar of retail sales. And you can see that right here, $10.6 billion of top line revenue, and they kept $66.270 billion of gross profit. That's a fantastic margin. And it's getting larger as they scale. How does that gross profit margin of 60%, roughly, it's 59 and change, compare to other, women's apparel companies or other apparel businesses in general, Grok?
That 60% gross profit margin is impressive. Compared to other apparel businesses, it's on the higher end. In 2025, the average gross margin for the apparel and accessories industry is around 45%, with retail apparel closer to 39% in some quarters.
45% versus they're at almost 60%. That's a 15% or a 1,500 basis point improvement in margin relative to the average for apparel business. Please continue.
Right. That 15% or 1,500 basis point gap is significant. It shows Lululemon's premium branding and efficient supply chain give them a big edge. Compared to peers, companies like Nike typically run around 44 to 46% gross margins, while fast fashion brands like H&M or Zara are closer to 50 to 52%. Higher-end activewear brands like Athleta might hit 55% in good years, but Lululemon's near 60% is top tier, driven by strong pricing power and direct-to-consumer sales. Want to dive into how this impacts their valuation or move to another part of the financials for your video?
No, not yet. Thank you for the background. So on the P&L here, you've got a business that's growing top line revenue by $1 billion year over year, growing strong double digits, gross profit margins in terms of industry-wide performance. Those are two huge hallmarks, kind of feathers in their cap, if you will, as we're going down the P&L. So let's keep going. Selling SG&A, so sales, general administrative costs. This is the corporate cost to run the business, what they call the fixed cost generally in a business. So as top line revenue grows, your cost of goods will grow along with the revenue. So you have your gross profit. That's the variable revenue component, variable cost component. The fixed cost, which you want to see hold steady as revenue scales to increase margin, is currently $3.8 billion last year for the general administrative expenses. That's up from 3.4 the prior year. So what happened is year over year, they expensed an additional $350 million of selling, general, and administrative expenses to operate in 2025 versus 2024. Meanwhile, gross profit went up from $5.6 billion to $6.2 billion. That is about $800 million versus a SG&A increase of $300 billion. So they definitely made more profit as a result of higher revenue year over year and a fixed and slower growing fixed cost. What do you think, Rob?
That's a smart breakdown. It looks like Lululemon managed their SG&A well, keeping it growing slower than their gross profit. So, you've got gross profit jumping by about $600 million from $5.6 billion to $6.2 billion, while SG&A only went up $350 million from $3.4 to $3.8 billion. That's a nice leverage point. Revenue and profit are outpacing fixed cost growth, which boosts their operating margin. It shows they're scaling efficiently, likely from spreading those fixed costs over more stores and higher sales volume. Want to dig into operating income next to see how this flows through to the bottom line for your video?
What's the SG&A cost as a percent of revenue, and how does that compare to the industry average?
For 2025, Lululemon's SG&A as a percent of revenue is about 35.85%. That's $3.8 billion in SG&A divided by $10.588 billion in net revenue. Compared to the apparel industry, where SG&A typically runs around 30 to 40% of revenue, Lululemon's in the higher range, but not unusual for a premium brand. For example, Nike's SG&A is around 32 to 34%, while fast fashion, like H&M, can hit 40% or more. Lululemon's slightly elevated SG&A reflects their heavy investment in brand marketing and store expansion, but it's still manageable given their strong gross margins. Want to dig into how this impacts their operating margin or move to another metric for your video?
No, I just want to summarize. So they're at 35% of revenue. That seems to be in line or slightly high for the industry. But their gross profit, which I think really matters, is much higher than other industry averages. Okay, I'm going to keep going. So operating income, last year they made $2.5 billion of operating income. That's up $400 million year over year and up $1.2 billion in 2 years. That's remarkable to be able to do that in 2 years and have the stock down as much as it is. Very interesting. And then we come down to shares outstanding, fully diluted weighted average numbers of outstanding 123,935,000. That is down from the prior year of 127 million and down from 2 years back of 128 million shares outstanding. That's fantastic. So they're buying back shares. Let's take a look at the balance sheet, give this a smell check and see where they stand. Current cash equivalent, CEO is right. He said just under $2 billion of cash and cash equivalents. AR, very, very small. Inventory, let's make sure they're not carrying too much inventory. $1.4 billion of inventory. That's actually only slightly higher than $1.3 billion year over year. That doesn't seem unreasonable at all to me. Prepaid expenses receivable, those are all really low. Total current assets, 3.9, call it $4 billion, we'll round up, $4 billion. Property, plant, and equipment, 1.7 billion, 1.8. Right of use asset, these are leases, rental leases that they've had to capitalize. Goodwill is very, very small. I like to see that. So most of their assets, most of the total assets, 7.6 billion in total assets, is actually consisting of current assets, being cash, the largest one, plus inventory. That's actually really nice to see. Let's take a look at the liability section now. So account payable, 271 million, accrued liabilities, compensation related expenses. These are all current liabilities. Current leasehold improvement, current leases, unredeemed gift cards. They've got to carry that always. And then that's $1.8 billion. That's very low. Long-term debt. I don't see any long-term debt, like long-term bank debt here, for total liabilities of 3.2 billion. They can pay all liabilities with current assets here. This is Benjamin Graham special right here, ladies and gentlemen. You can use the current assets of this business to pay all of the liabilities of the business. Let me go main screen here and change this up and just stop the video here for a minute. This is incredibly rare, and I want everyone to stop and take a look at the pristine balance sheet of this business. You don't see this very often. So we have a case here where the stockholders, the equity holders, that's you and me. If you buy the stock, you're buying the common equity at the on the market. You have a position, you have an opportunity in this stock to own an equity position, meaning you have equity-like upside. You're a stockholder. But you have bond-like collateral position. What does that mean? Well, they call it a capital stack, or the cap table, if you will. Well, that's the equity side. I'll call it a capital stack. That is the hierarchy of the capital, the money that's raised by a business. And it starts with the most senior debt position, typically like a bank debt. And we, on this channel, look for 3 times leverage on a business as the maximum amount of debt that you would want to put on a business. That's basically the amount of leverage a senior commercial bank is willing to put on a business. In this case, you don't have that. There's none of that in place. Typically, the next layer of debt in this capital stack, the next step down in its claim on the assets, if you were ever in bankruptcy court, would be junior debt. Junior debt is just subordinated debt to the mortgage. Think of like a second on your home, or a home equity line of credit. If you have a primary mortgage on your house and you get a HELOC on top of that, that HELOC is subordinated to your primary loan. So that's called junior debt, and it's slightly higher. Usually could be it could be like 2 to 3%, 4% higher than your primary loan interest rate for a company. And then after that, you have mezzanine debt. Mezzanine is kind of like a quasi-equity. Usually comes with some sort of equity-like kicker. Then you have preferred stock, and finally common stock. My long rambling point here is that there is none of that in here. So you and I, as equity holders, there is nothing in between us and the assets. Should Lululemon unfortunately go bankrupt and not completely piss away all their cash trying not to go bankrupt, this current balance sheet of $7.6 billion of assets could be liquidated, and that liquid assets would cover all of the debt that's currently on the balance sheet and leave something left for the stockholders. You wouldn't get all your money back, but you would have assets you could go after, and that collateral position is very, very unusual in this post low interest rate environment where everyone went nuts with debt. So that's why Benjamin Graham always looked at it. He would always look for stocks you can buy for where their current assets are worth more than all the liabilities, and this one checks the box. So let's keep diving through. Let's go to the cash flow statement and just make sure for a second that they are generating positive cash flow. Remember, there are 3 sections to the cash flow statement: your operating cash flow, your investing, and your financing. And it looks like operating cash flow, they made $2.2 billion of operating cash flow last year. Let's check stock-based compensation right here, $90 million. That's incredibly low. I love to see that. They're treating the shareholders with respect by not diluting them. They made a ton of cash last year, $2.2 billion of jack, just running their business and selling their wares. That's fantastic. They purchased property, plant, and equipment, meaning they most likely built stores with this money of almost $700 million. But that still leaves a ton of cash left over for acquisitions or expansion or buying back shares or paying dividends. What do they do with the stock, with the money? Well, they bought back a metric shit ton of stock. They bought $1.6 billion of stock back last year. That's incredible. That's up from $500 billion the prior year. So they also realize that their stock is undervalued, and they are also buying back stock. That seems fantastic. Good for them. Let's dive through the cash flow club now and take a look. Here's the cumulative drop in price. Well, not cumulative. I guess it's just the drop in price. Just over time. So you can see, it IPO'd in 2007. You had a magnificent run from, call it $50 to $500. So it 10x'd from 2017 to 2024. And it's now fallen back from a peak of $500 a share to under $200 a share right now. That's an incredible drop, and I think presents a very interesting opportunity for this stock. Let's see, 10-year return, moving day average, breaking down below that. Let's see, year-to-date return. Year-to-date return 2024, it was negative 60%. Youch. Year-to-date 2025, again, we're in the cash flow club. If you don't know what that is, check my bio, join it. We've got lots of stocks in here from our analysts that are cranking through phenomenal companies. Stock down another 50% in 20. So you lost 60% of money in 2024, and you're down another 50% in 2025. Ouch. Outstanding opportunity for someone to take a de-risked position. Here's LTM revenue over the last 10 years, still growing every single LTM period. It looks like it's higher with the exception of maybe just COVID. That's it. Everything else is up. Let's see. Here's EBITDA. That's a quarterly EBITDA. EBITDA margin. So here's LTM EBITDA and EBITDA margin. EBITDA margin is growing. It's approaching north of 25%. It's been growing over the last decade, and so has EBITDA. Even though the growth has slowed a little bit, it's still increasing. Let's see, what else do we have? CapEx margin. I want the EV EBITDA, or here's the share buyback. Here you go. Look at this. Weighted average shares outstanding. Look at the drop in the shares outstanding. Oh, unreal. They are buying back a ton of stock. Remember what we said, this is a long time ago, we always talk about a trifecta stock. What is a trifecta stock? You want 3 things in a stock that really produce the hockey stick return. I'll go full screen on this monologue. What is a trifecta stock here in the channel? It's 3 things, and it's a stock that has growing earnings. It's a stock with that's buying back its own shares. And you have a company that is a market multiple expansion opportunity. This stock is exactly that. It is buying back its own shares. Earnings are growing. They were up 15% year over year. That's what the CEO said. And the market multiple of the stock, I bet you, is an opportunity to expand. And that compounding makes a hockey stick return. And that's why most likely Michael Burry has bought this stock. I think there's a lot in here that would please him as a value investor. What I don't see is the enterprise value to EBITDA, but we'll get to it. Let's zip down. Oh, here it is. Let's see. We got a lot of stocks. If you're not in the cash flow club, by the way, you guys are missing out. Let me flip back to the share screen so you can see what I'm looking at. I got a lot of valuations. Here you go. This is exactly what I want to see right here. The enterprise value to EBITDA market multiple. So historically, this stock has traded someplace in the 20 times ratio. You can currently buy it for 7.8 times enterprise value forward EBITDA. That's incredibly low. And it's been as high as 46 times. So there's your market multiple opportunity. You're buying it at, call it 8x. It reverts back to its mean. Maybe it doesn't go all the way to 20% because growth is lower, but it comes up to 10 or 12. On the conservative side, you get that expansion multiple opportunity. So very, very attractive. Let's pull up the cash flow statement, the cash flow club one pager, and just take a look at the forecast. So if last year they made $2.9 billion of EBITDA, and we say that 2026 is going to be kind of a down year, just as conservative, we can apply a very conservative growth rate to this EBITDA and say it grows 5% every year for the next decade, targeting $4.6 billion of EBITDA in 10 years. Historically, the stock has grown at 24% on an EBITDA basis, annualized for the last decade. Now, if I just say it grows at 5% forward, that seems very, very low to me. I apply a 10 times market multiple of that, which is also very low given historical range of 17 to 40. That produces an enterprise value of $446 billion or a $363 stock price. You can currently buy the stock for $186 a share. That is a doubling in the stock price over the next decade. Not to mention the free cash flow you get, not to mention that you could go higher than a 10x. You could be 12 or 13 or 15. So I think there's tremendous possibility here. We're forecasting the cash flow club a market-beating return here, an IRR of almost 14%. That's 40% above what the S&P 500 will do over the next decade. Very attractive return ratio. Let's review the 5 key attributes that we look for in a stock before we consider doing more due diligence. Number 1, top line revenue growth. Let me go full screen again so I can do my monologue. What is top line revenue for this? It's growing. It grew $1 billion year over year. Remember, from 9 and change to just over 10. Historically, it's done 20% annual growth rate over the last decade. So someplace in there, it should, fingers crossed, continue to grow. It has market-leading margins on the gross margin. It's keeping SG&A at a slower growth rate than top-line revenue growth, and it's producing a positive net income and EBITDA, which is the second thing we look for, is enterprise-level earnings for a business need to be growing. These are growing. And then the next thing we look for, right, is strong free cash flow. They made $2.2 billion of operating cash flow last year. CapEx was very low, and they're buying back shares. So that free cash flow is strong, and it's available to the equity holders because it's not burdened by debt. Debt specifically, they have zero debt. You see that very infrequently in this market, and the current assets that they have will cover all of their liabilities and some. And lastly, is it a reasonable value? Buying this stock at 7-8 times enterprise value is very, very cheap, in my opinion, for the possible upside of this business. Let's just see what its current enterprise value is. $186 a share times 240 million shares gives me a $23 billion enterprise value. That enterprise value, or market cap in this case, because they're the same, there's no debt, has been as high as $60 billion. So if it returned to that high, you would make 3 times your money just in price appreciation alone, not to mention added growth that they can achieve with the free cash that they have. So for all those factors, I think it's reasonably priced, and I think that means that this stock meets all the categories, all the criteria that we look for on our 5 key attributes. It's also a trifecta opportunity which in this market, by the way, for the Case-Shiller ratio to be at dot-com era bubbles, diving into a stock that has no debt like this, growing top line, growing bottom line, strong free cash flow, buying back shares, market multiple opportunity, is a very interesting way to safeguard some cash if the market takes a dump and, I don't know, you have, two or three stocks that are, say, 10% of the S&P 500, you can have a problem with people selling out of the S&P 500 and everything coming down and having large downward pressure on the market. Being in a business such as this might be a safe haven for you if you think of it that way, as opposed to always looking for growth. How do you protect and preserve capital? I think you do it by looking into stocks such as Lululemon and saying, hey, they had a tough go of the tariff discussion. They saw some weakness in the U.S. market through competition. I totally agree. It's not the same market it was 10 years ago, but the brand name is huge. The loyalty is following. They're still selling, still growing, still profitable, no debt. I mean, what's not to like? Aside from there is no, the moat is basically the brand, but that's just like Nike, and Nike's been around for 60 years. It's just like McDonald's. It's just like a lot of other big branded companies. It's just like Coca-Cola, for that matter, and Pepsi. All these stocks are brand companies. So I see that as, it's not a waste management company where you have to buy it. It's not Microsoft, where you can't even do this show here without their products. So it's not nearly as sticky as that. But then again, you're buying it for 7 times earnings, not paying 30 some odd or 50 some odd or 100 for something like a Palantir. So, I think that payback period being so short warrants the risk of less sticky customer, because I don't, I still think that the customers seem to be coming back to this business, even though there's been increased competition. Their margins are super strong to defend their position, and should they have to, they could give up some margin by lowering price and being a bit more competitive in the market if they choose to. So this is the cash flow show. I really appreciate everyone and all the other comments. I don't think I said this at the outset. My name is Cameron Stewart, CFA. Happy to take questions or comments on this review of Lululemon. It does seem to check all the boxes that we look for, right? Revenue growth, earnings growth, strong free cash flow, low debt, and well priced. Those, I think, are all checked. I'll give this the extra nod for the trifecta opportunity that this stock presents, because it's been down 60% stock loss value in 2024 and another 50% down in 2025, has reduced this stock to a place where for $24 billion, if I had the money, I would take this company private in a heartbeat. And it's something like an Ares Capital Management, a Blackstone, a KKR, could absolutely buy this business tomorrow, leverage it, and take it private. If anybody wants to, happy to try to raise, it'd probably cost you, a market premium, say an extra $10 billion to take it private. So it'd cost you probably $35 billion. If anybody wants to help raise $35 billion to take Lululemon private, let's go do it. But very interesting stock. If you want to learn more about these stocks, you can join the Cash Flow Club. See the link in the bio. Or if you want to know how to value companies, how to build forecast models like I showed you, happy to walk you through it. I've got courses on my website. Take a look, check it out. Let me know what else you'd like to see. Happy to dive more deeply into other stocks. Got more videos coming. Thanks for all the comments, questions. If you liked the video, hit a like, throw a comment down below, helps the algorithm. And feel free to share it. Thanks very much. Take care. Bye-bye.